Welcome to today's webinar, When the Market Feels Like a Minefield, How to Move Forward Confidently. We saw in the queue that we have some current clients and new faces, so I just want to welcome both of you today. Two housekeeping items before we get going. First, Amanda is going to be sending you these slides, so you're able to go through them on your own accord, either during or after the webinar. And of course, you can always ask questions. And then also, two, at the bottom of your screen, you're going to see a button for questions. So at the end, we're going to be answering any questions that you have. So feel free to put any questions that you have as we're speaking into that box there. So because we have new faces with us today, I just want to take a quick second to introduce us. So this handsome fellow on the left is myself. I had joined Stonehearth Capital in 2022. I've been in the business for about 15 years now. I'm a senior financial advisor here. And Jamie on the right, he owns the company. He actually started here in 2000 and worked his way up and bought the company in 2017. Just want to give a quick second for him to say hello.
Good morning, everyone. Thanks for joining us.
So we are super excited that you were able to join us because we know things are a little bit volatile out there. And we thought it would be a good time to go back to the basics to walk through our process, since this is why we created this process, because of times like these. So let's start with, why are we stuck? How did we get here? How did the car get in the mud puddle, so to speak? And you're seeing a lot of things. I mean, there's a lot of change technologically, of course, with AI. Social media is always loud. And then, of course, we have market volatility. And then, of course, we have all the stuff going on with politics. So what usually happens is that you turn into what we've seen actually is clients get into this financial paralysis. So they're so scared to make the wrong decision that they make no decision. So they just kind of freeze. And that's extremely common because you're mixing two taboo topics. So what I mean by that is that you have money that's this emotionally charged topic on top of, say, politics. You mix those together. I mean, you're not going to knock on your neighbor's door and say, "Hey, how you doing with money?" It's just not something we talk about. So when you mix these things together, it just becomes this standstill. So today we wanted to say, okay, well, let's talk about it. Let's dive into the uncomfortable and why we feel our process is what helps people clear their vision. And when your vision is clear, it's super easy to make decisions and feel confident no matter what's happening, that you're going to be comfortable moving forward. So, like any novel movie, you got to build the scene before you get to the plot. So, to see where we're going, let's see where we've been. So, I like this goofy cartoon on the left, which is "We Didn't Start the Fire." So Billy Joel. That song, a lot of people have heard that classic. We don't have rights to the song, so we couldn't play it. But this is a good reminder that the questions and answers at the bottom, you can request Jamie to sing a bar for you. But I like this example because it just shows all these events that happened and what the market's done. So and the kind of theme I want to convey here is that the most dangerous words in investing is that this time is different. And that's because you end up making emotional decisions. And I want to bring up this song and this chart because I want to say we've been there before. During 1950 to 1990 is what the events the song is listing events on. And you had a president assassination, you had multiple wars, you had high inflation. You see here, you had multiple stock market crashes and downturns. And then, of course, during that period, 10,000 grows all the way to $212,000 by staying invested. And a lot of this comes from being a part of this emotional roller coaster. And Jamie and I really like this slide because we've all been there. And it's when the market's going up, you're feeling invincible. Similar to 2021, you're like, oh, there's no downturns, we're feeling great. You have all these plans to spend the money, and then of course you get the temporary setback, which every year, a little over a year or so on average, you'll see a 10% pullback, so that's normal. So people are more okay with that. And then of course you get into the further downturn and you're the 20, 30% down, and that's when people begin to panic. So think of it of like being on an actual roller coaster. You're building up the thrill going up. You have that pit in your stomach going down, and then you pull into port at the end. So that relief optimism. But a lot of times with investing, they don't get to port because they fall into this portion right here and say, you know what, the market's not for me. I'm not a good investor. And it really becomes a part of, okay, well, I don't know why I need to be invested, so why should I be invested? And this is extremely normal. The concept's called prospect theory, actually. It reveals that people weigh the pains of losses more heavily than gains, which, when you look at it statistically, I mean, the market's up historically over 70% of the time. So you're really focusing on the minority here, but it's extremely common. And that's when you focus on the minority and you think about it and it weighs more heavily on you, you're more likely to make those emotional decisions. So again, our purpose today is to say, okay, well, we have a process in place to help with this because we know the markets are going to go up, we know the markets are going to go down, but we don't know when. And your whatever phase you are in life isn't going to line up perfectly with this. So we want to plan for everything. So we use planning as an anchor. And so that's going to help set the stage here. And looking through the queue, it looked like we had people in each one of these stages. So I wanted to make sure that I addressed all three. And you have stage one, which you're in that stage where if you have kids, you're in that survive and advance stage, and then you're trying to save for retirement. Stage two is I see the light at the end of the tunnel, 8 to 10 years away. We need to start planning for it. And then, of course, we have stage three where you're retired, you're living off this money, and you're really trying to enjoy it and just really see that vision of wealth. And I say vision of wealth because that's important to articulate in all three stages that we're seeing here. So when we start planning for clients, it's identifying what's that vision of wealth. What is important to you? Is it realistic to get there based on your assets, your income, and so on? But also, two, just as important is that you want to look at the risks because it's easier to prepare than repair. And if you can get ahead of these things, they don't have to be catastrophic. But if you sit there, similar to if your brakes aren't working on your car, eventually they're going to go. So you need to go to the mechanic and get things tuned up. And then also, two, only current you can take care of future you. And stage three, the people in retirement are going to say, "What are you talking about, Joe? I don't have much future me left." That's a common phrase we see in our office. Well, there's actually a ton of things you can do. And it's when that gets into the tax planning side of things that we'll get into a little bit later. But there's a lot of different things that you can do to maintain your money, and of course, grow it to make sure that you're maintaining your lifestyle. Stage two, I'll use another common example. People say that they're retiring. They're like, you know what, I want to go into retirement with no debt. They'll pay off a large loan that has a low interest rate when they could have had their money working a lot harder for them. That could have built another 5 to 7 years of expenses by reapplying it elsewhere. And you're only saving a small amount of interest paid on that loan. And then, of course, stage one, you have the basic pre-tax versus after-tax, but also, too, there's things called mega backdoor Roth conversions that you can do. So there are a lot of different things you can do in all three stages. But the important part is okay, well, that's great. You just said a bunch of things and it sounds great, but how do you do it? Well, let's pull out the toolbox and look at the tools. So here, this is going to seem a bit overwhelming at first, but I just want to go through a couple key items that we look at and we like to go through with our clients. And what this is, again, is the tools in the toolbox. It's saying, okay, well, can you retire? And are you still going in the right direction? So there's a lot of stress testing that goes on here. And again, this is via e-money. So this is something that all of our clients have access to. And you see here in the top left-hand corner, you're seeing something very basic called the Monte Carlo simulation. So that's what that 84% is here. And here, what that's doing is sending your portfolio through 1,000 trials, looking at the best scenarios, the worst scenarios, and seeing, okay, do you pass in all of these different things? Because you don't know if you're going to retire when we have 10 years of bad markets like 2000 to 2009, or we're going to retire at a time where it's phenomenal markets like 2010 to 2020. So I'll get into more detail on that in another slide. And another thing that's been helpful, and again, the tools and toolbox is supposed to clear your vision. Again, we want to, your vision's clear, easy to make decisions. And I'm going to go over here to cash flow and net worth history. It's just so much more fun to spend than to save. But you have years that are more expensive than others. And there's stuff that you want to do, especially if you just retired and so on. So you want to be able to track your spending and see if you're still on pace. So this is another helpful tool to say, okay, are we trending in the right direction, the wrong direction? And do these one-time withdrawals really have an effect? Because again, it's not let's preserve our money. There's stuff that you want to do. We understand that everything that counts can't always be counted. So we want to build that into the plan. Asset allocation, most clients say, okay, that's your job, Joe and Jamie. But I wanted to bring this up just because of the recent volatility. I mean, this is important because it shows what you have on offense and what you have on defense. So what I mean by that is equities is your portion that's growth. It's going to outpace inflation. Your bonds and cash is that stability portion that don't keep up with inflation, but it's that stable part. So if someone called and needed money in, we'll call it April, we'd probably take from bonds because markets were down. Markets have recovered, so we want to take from strength if they call it today. So again, there's different strategic ways to pull money out of your portfolio, and we want to take that into account. And then the last one, so I'm going to skip over longevity risk because that ties into Monte Carlo. That's just saying, okay, well, what age do you run the most risk of running out of money? But going down to income taxes, this is extremely important when you're looking at plans. Doesn't matter what phase of the last slide that you're in, because there's usually a way that you can do things more efficiently. If everyone's different, but you always want to look to see if you can do something more efficient. Because, for example, if you're in stage one, and you're 45 years old and you want to reach $1 million by 65, if you started that at 45 versus 55, I mean 50, I apologize. It's a $15,000 difference that you'd have to make up on an annual basis to deposit. So that's using an 8% return until age 65. But again, it's one of these things where if you're in stage two, well, you're likely in your highest earning years. So you want to be able to defer income because you're about to be in a lower income bracket. So if you took it versus deferring it, you're deferring it, you're going to hold on to more of your money because, again, you're in a lower tax bracket than you are right before you retire. And then for seniors, I apologize for you in stage three. There is a lot of things to keep track there on the income tax side. It's IRMA. We don't want to affect your Medicare premiums. But we actually had a client about a month ago that was able to take, because of their income levels, they were able to take $50,000 of capital gains tax-free, given their income bracket. That's a 0% capital gains bracket. So there's different strategies you can do there. And then, of course, if your Social Security isn't that full 85% taxable, you want to make sure that you're doing things to keep it at that lower level. So looking at the cost overall. And I know Jamie's going to touch a little bit more on those things, but I just wanted to graze the surface to set the stage. Excuse me there. So there's one risk that I touched on briefly that I want to make sure that we touch on before I pass the baton to Jamie. So this is what's called sequence of return risk. So you see here, you have three investors, Mrs. Doe, Mr. White, Mr. Rush. And you see that they all have $1 million to start at age 65. And they're all making 7% annualized. So this number is being averaged out over 25 years. And And then they're all taking $60,000 adjusted for inflation. So $60 today is different than $60 5 years from now because of inflation. So quick refresher about if you took it from 2022 to 2025, January 1st, $100,000 is only buying you about $92,000 worth of goods. So you look over here, and Mrs. Doe is the lucky one. So remember in the last slide, I was talking about how between 2000 and 2009, your annualized return was negative 2.41% per year. And that's because you hit the dot-com bubble and you hit the '08 crisis. But in 2010 to 2020, you saw a bull market, a long bull market, and it averaged roughly around 12% a year. And I'm talking about the S&P 500 here. So that's on an annualized basis. And you see Mrs. Doe hit that ladder, that 2010 to 2020, and she hit that great market to start. And you see that her million, she dies at 90 with more money than she started. Mr. White, on the other hand, was not so lucky. He was in the first decade of 2000 to 2009, where you had that negative return to start, same withdrawal rate, same average return over time. But you see, here he ends up with zero. And then, of course, Mr. Rush is the lucky one. He's Mr. Consistency, and he ends up with a little under $500,000. So my point is that, and I want to use this slide to highlight this risk because it's important. And Jamie's about to get into asset allocation, but it's important because there's different ways you can combat this risk, because you don't want to judge your retirement based on what the market's doing. You want to walk out, you've worked your tail off your entire life. You want to walk out on your own terms when you're ready. And you don't want to worry about the market. So that's why that stage 2 is so important. It's saying, okay, well, you know you're going to retire at 65. What can we do to prepare for this to lead up to it? So just to wrap things up before I hand it off to Jamie, I'm just going to give some key points what I was trying to say before. Emotional decisions are usually bad decisions, so we want to try and take the emotion out of it and trust the process. And you'll see by the charts I showed and the chart that James is about to show, the longer you stay in the market, the safer it is. And it's one of these things where you have to know why you're invested, how you're invested, and is there a plan for this? And that usually helps people get out of this financial paralysis, because when your vision's clear, your decisions become super easy. So that's enough from me until questions and answers. So I'm going to hand things over to Jamie here.
All right, here we go. So first, just want to focus on the things that we're looking at today. We've all heard that uncertainty is super high. Just how high is it? Here's a chart from Ned Davis Research that shows from 1997 through 2025. You can look at how they're tracking uncertainty, and really what they're doing is they're doing surveys and looking at news articles to gauge uncertainty. You can see all the way up here in the far right-hand corner, it's next to the number 600. That is today. That is the current data, and this is why everybody's talking about the uncertainty. The next screen really highlights, well, all right, if uncertainty is high, is that a bad thing? Is it something that we need to do something about? Well, on the surface, when you have high uncertainty, you're usually trending towards employers that aren't necessarily going to hire people because they don't really have a confidence level as to how things might play out over the next couple of years. So they might hold back on making hiring decisions. Individual investors might not want to start investing in stocks or add to stocks during that period of high uncertainty. And you also have companies and families that might not want to put on that addition, or that think of that airline during COVID. Do you think they're really excited about purchasing a plane during that time frame? The answer is probably not. This chart, again, from Ned Davis, it's focusing on US uncertainty versus the S&P. So the blue line, which I know you can barely see, that is the level of uncertainty. And then the dotted line tracks the S&P. And what we're doing here is trying to look at the relationship between uncertainty levels and the S&P. And the key takeaway on the lower left-hand corner of this slide, there's actually what's called a correlation coefficient, and that's equal to a negative 0.09, and this data is since 1927. I just want to draw the relationship of what does correlation coefficient. That's something that we read about a lot. Maybe you do, maybe you don't have familiarity with this. Just think of two people that are dancing. If you have a correlation coefficient of a +1, that means these two dancers are in perfect harmony. They're in perfect sync. They're kicking at the right time. They're moving their hands at the right time. They're moving in unison. That's if something has a high correlation equal to 1, if we're talking about uncertainty in the S&P 500, if that equaled 1, we would know that if we have high uncertainty, then we should expect to see high volatility in the S&P. The next dancer does the two dancers do the exact opposite. So if one moves their right hand, the other one moves their left hand. If one steps forward, the other one steps back. That's a negative correlation equal to -1. The third option is when you have a correlation of 0, and think of two dancers that you put headphones on and you play different music through those headphones. Their dances, they might occasionally coincide, they might move in harmony, they might move the opposite, but in essence, it's just going to look all jarbled because there's really no relationship between how they're dancing because they're both listening to two different tunes. So here we can see that when you have uncertainty, which is at least on this chart an all-time high. The next closest was COVID. Um, it's not necessarily going to have an influence on the stock market volatility or trying to predict what the stock market volatility is going to look like. There was actually a study. See if I can get to the next slide. Here, it's from the Journal of Banking and Finance. It was done in 2023 by 3 individuals. And their takeaway was that the widely used variable of economic policy uncertainty is not helpful for predicting stock market volatility. That's surprising, but it's true. I showed you a research report that's showing this. I showed you data going back to 1927. So even though on the surface it looks like high uncertainty will lead to potentially stock market losses, that isn't necessarily the case. And I think today is a good example of that. I think COVID was a good example of that. Sometimes there's other forces at play that also kick in when there's economic policy uncertainty. Another thing that I want to draw people's attention to from J.P. Morgan, they have this chart that they've had for years. The solid bars just represent the calendar or annual return for the S&P 500 since, what is that, 1980, it looks like. And notice the good news is that most of the time it's on the top end of that chart, and that means that they experienced a positive rate of return. And then you do see some that are below the 0 line, and those are negative performance years. But those dots, those red dots, what they do is they show you intra-year, throughout the year, peak to trough, the worst or maximum drawdown that we've actually seen during each one of those years. So here's just a high, I just blew this up so that's easier for you to see. Here's 2022, 23, 24, and the current year 2025. So year to date, and this, I don't know what the final date is. This says May 30th. The S&P is up 1%. It's really the international markets that are performing much better this year. But fortunately, the S&P has clawed its way back to get to a positive rate of return because it has actually seen already, we're not even halfway through the year, a 19% intra-year correction. You can see last year there was an 8% intra-year correction, a 10%, and then a 25% back in 2022 when the market actually ended negative. So since 1980, despite average intra-year drops of 14.1%, annual returns were positive 34 of 45 years out of the 45 years. So the big takeaway is that these are not super uncommon, and especially if we have things like a 10% correction, that's actually the norm. I mean, since 1980 here, you're seeing that 14 was actually the norm. I'm going to switch gears here a little bit and talk about portfolios, and I'm going to try to not only show our portfolio structure and way of being, and also uh, recognize that there's other ways to actually manage assets, and one of those is a buy and hold philosophy, which we used to use, but after going through 2008, we have since changed. So first, you've probably heard this before. Don't put all your eggs in one basket. Boy, would somebody be upset with you if you dropped that basket of eggs, if that was the only basket that you have. If you go to our website, we created through ChatGPT a cool image that shows you the care that we put in with individual baskets for each egg. And it's just a good, it's just a funny visual to just show you that, it's important to diversify. There are pros and cons to that. Not everybody likes the idea of diversifying. I think it's appropriate for the mass affluent and for a lot of investors, but it might not be for everybody. But some of the pros is you can reduce risk, right? If you have individual baskets for each egg, if you drop one of the baskets, you still have all of the other ones that you didn't drop. You get a smoother ride because those individual baskets are holding asset classes that don't have a positive one correlation. So they'll be moving at different times in different directions. Sometimes they move in opposite directions, as I talked about with negative correlations. Um, you spread the opportunities, so we don't know what's going to perform next year really well, but gosh, if I have most of the different asset categories, I can at least make sure that I participate somewhat in that. Some of the cons, you may lag more concentrated portfolios. This has been so true over the last, say, 5 years. We've seen the Mag 7 or large cap, mega cap US stocks just perform amazingly. Well, while small caps and international and bonds have just been kind of boring and not that exciting. That changes. It always changes. We go through these cycles, and this is a year so far, year to date, with all the chaos, we've seen diversified portfolios actually doing better than U.S. markets, especially if you look at the S&P 500 being up only 1%. Um, Underwhelming when one asset class is surging. I mean, we all would love to have exposure to that one asset class when it's surging, but that's just hard to do, if not impossible. You got to get it right, not only on the buy side and the sell side. And then also you have a lot more to monitor when you build a diversified portfolio. This chart from BlackRock shows that you can win more by losing less. And this is really the idea of diversification. Why not just put all our money in the S&P 500? And that's the chart on the left where it says all the up and all the down. So it just says, hey, if the S&P is up 10, then you're up 10. If the S&P is down 10, you're down 10. And it compares it to a portfolio that only gets 80% of the upside and the downside of the S&P 500. In essence, you're adding diversification to the portfolio. And I know you can't see these numbers, but when you compare the same starting point to the ending point, which is 2007 to 2025, good time, a long time frame, you can see here that a diversified portfolio actually outperformed the S&P 500. So you can take less risk. And I know that this isn't always the same time frames. It doesn't always guarantee that that's going to take place, but there are time frames where diversified portfolios actually do better than the S&P 500. We want to remember that we should never think of investing as all in or all out. And the primary reason for that is because there's periods of time where if you miss the top 5 days where the market is really strong, you start to jeopardize your portfolio returns. So you really do want to stay invested, like Joe said, for the long term. Here's just the S&P 500. If you stay invested, sort of a buy and hold philosophy. And here's if you miss the top 5 days, the top 10 days, 15, 20, and 25 days, and you can just see it does more damage if you miss those up days. So one idea is to just buy and hold a basket of securities. And irrespective of whether, you think that there's headaches coming down the road, irrespective of turmoil, geopolitical, inflation, you just stay invested. And by the way, I'm very used to that because I started my career telling people that because that was the sort of the the most appropriate path to try to keep emotions out of investing. but it also resulted in these big swings. And you often had to tell people, close your eyes, shut off the TV, don't open your monthly statements. We just have to ride this out. Our founder, Rich Prout, and I, after 2008, said there has to be a better way to do this. And that's where we started incorporating models. Models are there to help decrease risk in the portfolio at certain times. They can also increase risk at certain times. And we use a weight of the evidence approach when doing so. This is Ned Davis research again. Not everybody has these tools, so maybe buy and hold is a better approach for a lot of families. But for money managers who have clients that are willing and the firms are willing to spend the time, energy, and resources to incorporate things like models, it's not cheap, but it can result in better performance over time. So this is sort of their flagship model. It's called their Fab Five. It tracks 34 individual indicators. Here's the S&P on the top. Here's the model score. This is what we really pay attention to. These are all the ingredients that go into the model, so we can click on anything. It's not a black box. And then we can look at the performance. Now, I know you can't see that stuff, so I'm going to zoom in and show you some of this. If I hit it just once, there we go. So performance, when this model has been in the bullish zone, you can see it says a positive 1.5. The S&P has averaged 26% annualized rates of returns. And the model is in this zone 37% of the time. It's in the neutral zone about 44% of the time, where the S&P average is 8. And then you got to watch out when we're in the negative zone. And when the S&P has averaged a negative 16%. This data goes back to 1982. And here's a picture of the data for the model for 2025. So you can see that it started the year in the neutral zone, fell down into the bearish zone, went back into the neutral zone where it stayed for quite a while. And then we hit some turmoil, stayed in the negative zone for a little bit longer. And then the market started to rally after we had the 90-day pause on tariffs. And then we also had some uncertainty that surfaced again. And we've been staying pretty close to the neutral zone. And that's actually right around where our portfolios are. We classify them as the neutral zone. This is a guide based on 34 indicators that drives our decisions on how much risk we take in portfolio, which is really focusing on how much stocks we put in the portfolio. This is only designed to be a half an hour presentation, so we're flying through some of these. I do want to just share with you how does Stonehearth help. The majority of new clients that come our way, they're experiencing one of these life transitions, whether it's approaching retirement, which is usually, they're looking at that usually around age 60. And they're usually focused in that phase on Social Security, Medicare, how to generate portfolio income when they turn off their wages, when they retire. At around 75, we tend to see that clients start to put a little bit more emphasis on estate planning and legacy planning. This is your estate plan set up right? Are your finances simplified? Do they have beneficiary designations? Are they the correct ones? And then, unfortunately, for some families, financial caregiving starts to step in where mom and dad just aren't doing so well. They maybe missed a couple bills, and the kids are giving us a call now and asking for some help and guidance in managing their parents' assets. So we're very comfortable and used to that. We've actually tailored most of our areas of expertise towards those three life transitions. So whether it's retirement income, income taxes, executive benefits, estate planning, or risk management, these are all areas that we're comfortable with. Our founder was an attorney, and he had his master's in estate planning. And I worked with him for about 17 years. So it's just an area that we are very comfortable with. Finally, I just want to address how we help clients when it comes to managing their finances, in particular their portfolio. Typically, it's focused on the starting point, which is trying to identify what risk tolerance they're comfortable with. Are they conservative, moderate, or an aggressive risk tolerance? That usually influences or has a heavy bearing on how and how we're going to slice and dice the portfolio. Each one of these colors is a different asset class. And if we have somebody that's more aggressively inclined, we'll add those colors that are more stock-based. And if somebody's more conservative, then we'll increase their allocation to more fixed income or bonds in the portfolio. And then finally, once the portfolio is set up, we have a monitoring and managing process where we're looking at the portfolio every quarter to rebalance it. We're constantly looking at products that we may need to swap in the portfolio because maybe they're not performing well, maybe they have a new manager, could be a variety of different reasons. Maybe we found somebody that's just better at doing this. We're always looking at tax loss harvesting opportunities in taxable accounts. That helps to reduce people's tax liabilities going forward. And then the big one that is very important today is this risk-based equity adjustments that we place, where we increase or reduce risk, which we've been doing rather frequently. I think we've done about 5 or 6 of these trades so far this year, so it's been a very active year for us. I want to thank everybody for coming. We're going to officially close the meeting right now. But for those that are submitted questions, we're going to stay on the line and we're going to try to answer those. But for those who have something else to do, we went over by a couple minutes. I apologize, but we did want to share this information with you, and thank you again for joining us today.
Very cool. So let's start with the first question we got here. How do I know if I'm at risk for sequence of return issues in retirement? Unfortunately, when you're speaking to the masses, usually it's any financial planning question is it depends. And what I mean by that is how your assets are structured, is if you're at risk or if you're not at risk. So that's where financial planning comes into play. But if I wanted to say just in general terms, I mean, you could reduce withdrawals during down markets. You could have a bigger cash reserve than expected. You could delay Social Security. And then, of course, you have the dynamic withdrawal strategies that you could do as well. Jamie, you would describe our firm as annuity curious.
Yeah, that's fair.
That's a strategy for some people. It's not for everybody. It's not something that it's something that usually our clients will tell us that they're interested in, and then of course we want to help in any way. So those are a few nuggets there, but there's a few more that you could do as well. So moving on to the next question. Can you explain what the weight of the evidence model is and how it influences your portfolio decisions? I'll let you take that one, Jamie.
Yeah, weight of the evidence, Chris describes it as we just don't want to have any blind spots. So you try to include enough factors or enough indicators that historically have worked at identifying whether you should increase or decrease risk. And they need to be broad enough so that you can identify them and that they have a bearing and a weight or they influence the model's score. The problem is you can weight them, you can spread things too far and wide. So you have to balance that. It can't be just one indicator. It can't be 5,000 indicators. So 34 is what Ned Davis research uses. They're pretty smart people. They've been doing this for over 50 years. They've got a great reputation. It's an expensive proposition for all the research that they're doing. I mean, we spend over 20,000 a year just to get access to their data. And it's because they put a lot of time, energy, and resources into making sure that their data is good, that it tracks things well. There's no back testing or hypotheticals that are in there. This is all live data that they're using when they're looking at these indicators. So we feel good about using that to help guide our decisions within portfolio.
Very cool. Next question. What's the difference between staying invested with a buy and hold approach versus using a model-driven strategy?
Yeah, I mean, I think that's a good question. Again, we've done both, so I'm intimately familiar with both thought processes. I've used this before, this analogy. Just pretend that you're that you're in your own town, the speed limit's 35 miles per hour, and you get in your car, you start driving, you set it on cruise control. Ignore stop signs, ignore traffic lights, just pretend it's kind of country road, and all of a sudden you notice that, hey, there's a tighter turn coming up. It's on cruise control. That's the buy and hold philosophy. You know it's coming. You've been here before, but you just need to stick to it, close your eyes. And you know what? The reality is you're probably going to be okay. But sometimes we know that if there's going to be an accident, that there's just a greater chance that it's going to happen at that turn. That's compared to using models to drive how much stock exposure you should have in the portfolio. It's that same example, except you're not necessarily putting it on cruise control. You're slowing down as you approach that turn. The end result is that you're going to get to the same place. Both of them have risks. You're out there driving. It's just you're taking control, you're lowering the risk in those environments where you know or you believe that there's greater risk of an accident happening. That's really the difference between the buy and hold philosophy and the model approach, which is what we use now and have been since I think about 2008 I'm sorry, not 2008. It was because of 2008, but we started using models to drive equity exposure in portfolios or maybe around 2010.
Awesome. And then we have a great follow-up question here. If diversification sometimes lags in bull markets, why should I stick with it?
Um, well, I think the slide that I showed that showed the S&P versus 80% of the performance of the S&P through diversification. I mean, there are periods of time where a diversified portfolio can actually do better than the S&P. That's been diversification goes in and out of favor. I think the most important thing for most people is once you've decided on an approach, you usually have to stick with that approach. So I'm not suggesting that diversified is right for everybody, but you usually don't want to be wishy-washy and going back and forth between strategies. So diversified portfolios will hold you back at times, but usually when there's more volatility, in particular a correction that's embedded in there, as long as you lose less, your upside doesn't have to be as strong. I always use the example if you have a dollar and you lose 10%, you're at $90. I'm sorry, if you're at $100 and you lose 10%, you're at $90. If you then gain 10%, you're only at $99 because you're building off of a lower base at $90. So there's just an unfair disadvantage that takes place if you're not paying attention to downside risk.
Awesome. So last question here. What is one small step someone can take right now to feel more financially grounded? Similar to question one, it depends, but the simple steps compound into big returns. So it really depends on what phase of life you're in, whether you're in stage one, where you're early in your career, pre-retirement. That could be something as simple as increasing your 401k contribution, looking to see if you have that after-tax option, which of course is different than a Roth IRA. And there's a great article on our website that explains that. If you're 1 to 2 years from retirement, I mean, generally you want to build a bigger cash reserve because once you stop saving, you're spending. So again, it's getting into that mode of understanding that your assets are generally going in a different direction. And then, of course, in retirement, there's a lot of different things you can do, as I spoke about before, just including guardrails and knowing that you can spend, but just how much you spend, whether it's 4 or 5%, depending on how your assets are structured. And also, too, just being aware that some actions can create higher tax consequences. And from that aspect, you can create situations where you're giving away more money, which you didn't understand you were doing in the process. But again, it's one of these things where Amanda, myself, and Jamie are all three different people with three different goals. So it's going to differ between every person.
Excellent. Wonderful. Joe, you want to close us out?
Yep. Awesome. Well, thank you everyone for joining us today. It was a great chat with everyone. And if you have any questions for us, you can contact Jimmy or myself.
Excellent. Thanks for joining us today. Take
Here,
care.